Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks slip ahead of today's key US inflation data, 1 week from the Fed's final decision of the year. Israel steps up airstrikes and sends troops deeper into Syria, saying it has now destroyed most of the former Assad regime's military capabilities. And the United States weighs new, tougher sanctions against Russia's lucrative oil trade as it looks to restrict the Kremlin's war machine. Happy Wednesday. It is US inflation day, the countdown to that data point. Investors globally, of course, focused on that number, what it will mean for the Federal Reserve, and that decision come, of course, December the 18th. Currently, European futures pointing down by 0.2% after dropping 0.5 yesterday. US stocks were also off by the end of the session, down about 0.3%. Here in the UK, FTSE 100 futures pointing lower by about 32 points, off by 0.4%. S&P futures then, after the modest losses of yesterday, pointing higher by about 0.1%. Nasdaq 100 futures looking to add 25 points. Let's flip the board and look cross-asset. You could have see some readjustment across the Treasury curve on that data point. Broadly, headline inflation out of the US expected to come in at 2.7% for the month of November, year on year. That's a slight tick up. Core inflation, of course, will be in focus as well. 4.26 right now on the US benchmark, 4.23 on the US benchmark 10-year, 105 on euro dollar. A little less softer in the single currency so far in the session. Gold at 2,690, down 0.1%. And again, the yellow metal could move around the inflation story of the US. And Brent in focus on the Bloomberg reporting that further restrictions on Russian oil could be coming from the Biden administration. 72.67 on Brent, up 0.7%. Let's check in on Asian markets right now then and bring in Avril Hong in Singapore, once again with the eye on China. Avril.
Yeah, Tom, we're keeping an eye on that Central Economic Work Conference underway in China and, the sense of whether we're going to see clearer, concrete details on stimulus after the Politburo's forceful stimulus signals earlier in the week. But given how markets have been disappointed before, certainly we're seeing that sense of uncertainty and skepticism in Chinese stocks that have really been struggling to clock gains today. But we're also keeping an eye on the rest of Asia ahead of the US CPI print. Worth noting here that the trading volumes are lower than are typical this time in the session. Korea is clocking gains. You have a bit of a technical rebound after the slump given the political turmoil in the country. I also wanted to flag that in terms of sectors, tech is not doing well. We have TSMC down for a second day despite pretty solid sales. And this is against the backdrop of the sector increasingly being drawn into competition between the US and China. Now, as I say, for Chinese stocks, they're struggling. Where we're really seeing gains are in bonds. And just a day ago, we actually saw on the 10-year the biggest gain in about 4 years. And MLife's Mark Cranfield is making the point that, yes, the fundamentals do support the view for longer term, these yields to continue declining. But that doesn't mean that in the short term, traders are getting ahead of themselves. And if we see some form of policy disappointment, we could also see a sudden reversal, a buy the rumor, sell the fact kind of reaction in the market. So keep that in mind as we keep an eye on assets in China. Flip the board, if we can talk through what we're seeing on dollar yen, because of course, next week is not just about the Federal Reserve, it's also about the Bank of Japan. And the central bank in Japan have been sending pretty confusing signals to the market recently. Earlier in the week, it announced that its deputy governor would be giving a speech to local business leaders ahead of the January meeting. So speculation is that that's a way for policymakers to communicate a hike in January. So the bets of a December move, that's next week, have receded against the backdrop. We're seeing a bit of weakness in the Japanese currency, although it firmed a little earlier in the session after a hotter than expected producer inflation print. Tom.
OK, looking ahead to that BOJ meeting and the decision, of course, at hand for officials and the governor next week out of Japan, and also a view, of course, and a finger on the pulse of what's happening in terms of Beijing and that crucial annual economic meeting that is taking place and wraps up at some point tomorrow. It's a two-day meeting. Avril Hong in Singapore, thank you very much indeed with the market check out of Asia. Looking ahead to US CPI later today then. Forecasters expecting the data to show a fourth straight month of firm increases in prices. For more on this, let's bring in Bloomberg's Valerie Teitel, our markets watcher, of course. Val, what are you going to be looking for when it comes to the data out of the US later on inflation?
Well, look, Tom, this is one of the last big data points of the year. We have this and the Fed meeting to cross until we close the books on 2024. The market is going to be keenly watching the core CPI metric in today's reading. This 0.3 month on month that we are expected to get would be the fourth in a row if we do get that 0.3 of that reading. And that is important, Tom, because a 0.3 takes us farther away from the Fed's 2% target. If you flip on, we can talk a little bit more about this core reading. The headline is expected to tick up on an annualized basis to 2.7, but it is going to be this core reading which could potentially shift the dial on the Fed. Many out there think that Friday's labor market report does cement that Fed cut next week, but we would have to get a substantial upside reading in this core metric to maybe throw that Fed cut in December in question. Many of us out there are also looking at this data point as perhaps something that could dent this equity market enthusiasm. We've seen small business confidence surge, consumer confidence also surge post-election. What has also been surging, Tom, is inflows into U.S.-linked ETFs. It has been a record year for those inflows. They crossed the $1 trillion mark just last week. But we're keenly awaiting the CPI report and the Fed meeting next week as something that could possibly dent this equity market enthusiasm before Trump takes office later in January.
Wow, $1 trillion of inflows into US ETFs. Valerie Teitel, thank you very much indeed. And again, a reminder to focus on the core part of that inflation data when it drops later today in terms of how it could shift, if at all, the views around the Fed. Switching focus right now. Israel has stepped up its attacks on military sites in Syria, hitting hundreds of targets from airfields to weapons production sites and sending troops deeper into the country. The Israeli armed forces say some 70 to 80% of the former regime's military capabilities in Syria have now been destroyed. Let's get more from Bloomberg Horizon's Middle East and Africa anchor, Jumana Pasechi. Jumana, what more do we know about the Israeli strikes and the rationale behind them?
Well, Tom, these strikes have really ramped up in the last couple of days. 300 sites have been targeted by Israeli air forces over the last 24 hours or so, and they've been targeting key military sites. They say they've been targeting chemical weapons warehouses. They've been targeting weapons stockpiles, including some of those surface-to-air missile launchers. In addition to that, also key air bases, not just around Damascus, but dotted around the country, even on some of the coastal areas as well. So per some of the local reporting and also per the IDF, around 7 to 80% of Syria's total military capabilities have been wiped out. And actually, some reporting suggests that their entire air force has been wiped out as well, not confirmed yet by our own reporting. But it is to suggest that Israel are going after some of these key military targets. And what the Prime Minister has said, the Benjamin Netanyahu, is that we have no intention of meddling in Syria's internal affairs, but we intend to do whatever is needed to guarantee our security. The concern, as articulated by the defense minister yesterday, is that they want to ensure that these key military infrastructure sites don't fall into the hands of what they describe as extremists and some of those more radical groups. So they're doing it with the purpose of securing the borders once more. But in return, some of the key Arab states, and we spoke about this yesterday, Saudi Arabia, Egypt, have massively condemned the actions that Israel have taken because they deem them to be capitalizing on this moment of weakness for the Syrian transition. And with the government with many questions lying ahead, they also say that it's a violation of international law, especially with Israel entering into that demilitarized buffer zone in the Golan Heights.
Well, where does this all leave Syria's security situation? And, of course, what presumably are pretty acute economic and political challenges ahead for the rebel groups who now lead that country?
Well, yesterday we found out that the leader of the transitional government is going to be Mohamed al-Bashir. So he is going to be the interim leader at least until March. That is the plan. A bit of interesting images yesterday because it was a very peaceful transition. You had the new leadership alongside new potential cabinet members sitting alongside former cabinet members under the Assad regime, essentially sort of handing the keys to the castle, as our colleague Sam Dagher has put it, which is interesting because many of those are obviously very closely associated with the regime that pursued a regime of dictatorship and brutal oppression, and yet there they were yesterday sitting next to the new interim prime minister. But so far, the transition has been peaceful. You talk about the massive road ahead. 90% of the Syrian population are living below the poverty line. 30% are living in extreme poverty. You talk about the huge amount of humanitarian assistance that's needed. You talk about the plight of refugees, 6.5 million refugees, also many of them looking to return back to the country. And so, yes, it is a very long road ahead, politically, economically. And let's not forget, Tom, as it stands right now, HTS, which is the main political group, so to speak, that's representing this government, are still labeled a terrorist organization by the US and other foreign powers.
6.5 million refugees and acute poverty. Bloomberg's Jumana Pasechi on some of the key challenges facing Syria in the weeks and months ahead. Jumana, our Horizons Middle East anchor, of course. Thank you. Here's what else to be thinking about today, then, at 1:30 p.m. UK time. It is the big one in terms of the data. It is the US inflation data print that we bring breaking down for you. That's at 1:30 p.m. UK time. So mark that in your calendars if you haven't already. Later today on the oil front, we have the Bloomberg reporting around potential additional measures restricting Russian oil flows. Well, the OPEC monthly oil report will drop later today. We will bring that to you. And on the earnings front, we have Inditex later today in about 20 minutes' time out of Europe. And then you have the consumer and retail story of Macy's. Those earnings dropping before the market stateside. So a touch on the consumer, of course, in the US. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. Coming up, the Biden administration mulls tighter sanctions on Russian oil exports just weeks ahead of Trump's return to the White House. More on that story next. Later, Workday is unveiling new features today for its AI platform, Illuminate. We're going to speak exclusively to the company's CEO, Carl Eschenbach. That's at 6:30 a.m. UK time. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Bloomberg has learnt that the United States is weighing new, harsher sanctions against Russia's lucrative oil trade, looking to squeeze the Kremlin's war machine just weeks, of course, before Donald Trump returns to the White House. Let's get more from Bloomberg's Bill Ferries. Bill, when we are talking about Russia, key questions then, what possibly more could this Biden administration do, given they've already put restrictions in place on the oil trade of Russia? And what is the logic, given that Biden's going to be stepping away in just a few weeks' time?
Yeah, so, the U.S. has long, since the start of this war, banned oil imports. They are reportedly looking at trying to do more to prevent Russia's oil exports. And so that could involve going after this dark fleet of ships that has kind of risen in the wake of these sanctions to carry Russian crude, mostly to places like India and China that are still willing to buy it and aren't too worried about the sanctions regime. There's also a chance they could go directly after the ships in this dark fleet. They could even have perhaps the U.S. military try to intercept some as a warning sign to other captains, other crews out there willing to take this oil on. We're trying to get some more of those details, but it does seem, the broader purpose here is to try to do as much as possible to squeeze Russia's economy, to squeeze its revenue flows before Donald Trump takes office. And may try to seek some kind of an agreement, a truce between Russia and Ukraine to try to give Ukraine basically as much leverage as possible heading into potential talks next year.
What does this mean for countries like India and China, the biggest buyers now of Russian oil? And to what extent does that make this a more complicated effort from the Biden administration?
It's going to be a very tough needle to thread for the Biden administration. The U.S. has in many ways kind of looked the other way as this dark fleet of tankers rose to supply India and China. The benefit to the U.S. of allowing that to happen, of course, is that there was less of a spike in energy prices, and that kept just fuel costs at home domestically in the United States lower. Those prices are lower now than they were, and there's no presidential election, so the Biden administration feels like it can take a little bit more of a gamble. But if they do anything that makes it, for instance, that have sanctions hitting Indian companies, Chinese companies more directly, that's going to become much more of a geopolitical problem for both the Biden administration and the incoming Trump administration.
Bill, before we let you go, we also have an update and more action from President Biden as he, of course, works through his final weeks, which is to formally block the sale, this at least is what we expect, of US steel to Nippon steel. Not a big surprise. What do we know then about the details on this and the impact, potentially?
Well, this deal has been under review by the Committee on Foreign Investment in the United States, CFIUS. They are expected now to pass a recommendation to the president just before Christmas, so around December 22nd, 23rd. That gives President Biden about 2 weeks to make a formal decision. He's been against it the whole time. But it does look like there will be something done within this administration, that it won't drag out. This $14 billion deal has been at risk from the beginning, but there was some question about whether the Biden administration would kind of kick the can and let a final decision come during the Trump era. That doesn't look likely to happen now.
OK, Bloomberg's Bill Ferries, thank you very much indeed, wrapping up those key stories for us on Russian oil and US steel. Now, some other stories making the news this Wednesday. President-elect Donald Trump says his administration would help expedite permits, including environmental approvals for those investing at least $1 billion in the US. Trump did not provide any details about the steps he would take to help investors secure the permits to fast-track projects. Any such effort is likely to face hurdles at the state and local level. And Trump has picked Andrew Ferguson as chair of the Federal Trade Commission. The politically charged role is currently held by Lina Khan. Trump says his pick has a proven record of standing up to big tech censorship and supporting freedom of speech. Ferguson is one of two Republicans at the 5-member Antitrust and Consumer Protection Agency. The suspect in the murder of United Health Group CEO is fighting being sent to New York to face charges, potentially setting up a long legal process. Luigi Mangione faced a court hearing in Pennsylvania where he was arrested on gun and fake ID charges. His lawyer says the 26-year-old will contest any extradition request. The judge denied Mangione bail to face court again on December the 23rd. Coming up, the Dutch finance minister is pushing for EU scrutiny of France's budget plans. We're going to bring you that exclusive interview next. This is Bloomberg. Welcome back. Now, German Chancellor Olaf Scholz has proposed a reduction of VAT on basic groceries to help low-income households cope with persistently high inflation. Scholz, who's running for a second term in an election expected in February, said he's in favour of reducing the sales tax on everyday food products from 7% to 5%. France's president is said to be working on piecing together a coalition of moderates to govern until his term ends in 2027. We're told Emmanuel Macron wants to free the government from the stranglehold of National Rally leader Marine Le Pen. He's also expected to name a new prime minister within 48 hours after Michel Barnier was toppled, of course, in a no-confidence motion last week. The Dutch finance minister says the political chaos in France does not mean the country's budget should escape European Union scrutiny. In a wide-ranging exclusive interview with Bloomberg's Oliver Crook, Ilke Heinen discussed the market fallout from the recent drama in France and the Mercosur trade deal.
The challenges are quite big that they're facing, but everybody's aware of this. And I talked to my colleague, the Minister of Finance of France. He knows it. He presents budgets to make the budget cuts. Politically, it's a bit difficult to get support for that, but I do see very much a committed government in order to get the government finances back in control.
And another issue that sort of is also dividing opinion within Europe is the trade deal that was just signed on Friday with Ursula von der Leyen and the Mercosur countries in Latin America. The Netherlands has been also quite concerned, I think, on some of the issues, particularly in agriculture. What is your position? Are you ready to oppose the deal?
Well, we don't have a position yet. I haven't seen the text, so the final agreement. I think it's published today, so we're going to study it and then we come to a position in it.
Have you been talking to your French counterpart, the Italian counterparts, because they're the ones who are raising, I think, greatest amount of objection?
No, it's not a big topic yet because everybody's waiting for the final agreement to read it and what the implications are.
What are your hopes for the relationship with the United Kingdom going forward? Do you see any sort of concrete paths forward there?
Well, first of all, I think it's very good that Richard Reeves, who was here in the Eurogroup, made a statement. He wants to reset the relationship. So he's looking for cooperation, which I embrace. For the Netherlands, the UK is an important partner. It's a neighboring country, and we share a lot of interest in security and economics. So I'm very pleased that they're looking for the cooperation. However, the discussion was also about tariffs, and the tariffs hurt trade, and with that we have Europe, which I reminded them, like, if you don't want tariffs, you should join Europe.
And the issue of tariffs is also another one that's very present in our minds with the presidency of Donald Trump beginning again in January. Is this a conversation that you were having about sort of strategizing about how potentially to address tariffs at the EU level? This is one of the big concerns going forward for the European economy.
Yeah, look, this is more like a wait-and-see approach. So the new government has to be installed, a new presidency. We haven't seen any proposals yet, so we're not going to speculate on that. In the discussion about tariffs, I also always look at the European internal market. The IMF recently published a very interesting paper. They said the internal market, if you compare it to tariffs, on goods, it compares to tariffs of above 40% still. On services, above 100%. So everyone have more free trade. If we're really worried about cooperation, lower tariffs, we should look at the internal market. And there's a lot of work to do for Europe by itself.
That was the Dutch Finance Minister Heinen speaking to Bloomberg's Oliver Crook. Stay with us for more discussion, by the way, about the outlook for Europe's economies. The Polish Finance Minister Andrzej Domanski joins us at 7:30 a.m. London time. So stay tuned for that conversation. To Asia now, where South Korea's President Yoon looks set to fight on rather than step down early as investigations deepen into his martial law declaration. According to a local newspaper report, Yoon has rejected the idea of quitting before the end of his term in February or March next year. Korea's opposition now says it will seek another impeachment motion this Saturday following last weekend's failed vote. Coming up, we're going to be speaking exclusively to Workday's CEO, Carl Eschenbach, on their AI features, how they look to monetize some of those products, what the upside could be for revenues, and their push as well into the European market at a time, of course, of tepid Eurozone growth. That is coming up. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks slip ahead of today's key US inflation data 1 week from the Fed's final decision of the year. Israel steps up airstrikes and sends troops deeper into Syria, saying it has now destroyed most of the former Assad regime's military capabilities. Plus, things going from bad to worse for London's IPO market, with the value of listings this year trailing Luxembourg and Oman. Let's check in on the markets then. European markets dropped about 0.5% yesterday. It was a challenging day for European stocks after, 8 straight days of gains. Today, European futures pointing lower by about 0.1%. Something of a holding pattern setting in for these markets ahead of the key US inflation data, of course, on a headline basis for the month of November, expected to tick up to 2.7% out of the US. That data will drop later today and could, of course, rewrite expectations around the Fed. Markets currently pricing in about an 85% chance that the Fed will cut again on December the 18th. So European futures then a little softer. FTSE 100 futures pointing lower by 0.3%. S&P futures pointed to gains of 1/10 after a little bit of softness yesterday, ending the day down 0.3%. Nasdaq 100 futures pointed to gains of 34 points. Let's flip the board and look cross-asset then. We look at euro-dollar. We look, of course, at treasuries. The US 10-year currently largely unchanged, yielding you 4.23. Euro-dollar at 1.05. Gold's little unchanged, unfazed it seems as we lead up to that inflation print. 2,695 on the yellow metal. Brent getting a lift up 0.6%. Bloomberg reporting that the Biden administration could be considering further restrictions on Russian oil. 72.63 on Brent. We have lines crossing when it comes to the earnings story out of Inditex. It's a company that has just done so well in terms of the stock performance year to date, up about 40% year to date. Here are the details then in terms of the 9-month EBITDA coming through for Inditex. It's a miss versus the estimates. You're getting a print of 7.97 billion euros. The estimates had been for just above 8 billion euros. So it is a slight miss there in terms of the first 9 months for Inditex. EBITDA coming in just shy of 8 billion euros. Estimates had been for a little above 8 billion euros. They now see sales at a constant FX rate of between November the 1st and December the 9th, up 9%. And again, the details in terms of some of the FX challenges we are going to be looking for. But again, this is a stock that has performed very well year to date, up about 40% year to date. The expectation had been that they'd come through with another solid set of numbers. Inditex 9-month EBITDA coming in at 5.67 billion euros. That is, again, slightly below the estimates of 5.8 billion. So a bit of a miss for Inditex for a stock that, again, has performed very well year to date. We'll get more details on that and be a stock to watch for you at the open at 8 a.m. UK time. Now, to artificial intelligence, and Workday has rolled out new features today from its AI platform, Illuminate. The updates are aimed at helping managers access employee feedback quickly, making it easier to make decisions and increase team engagement. It comes as the company which sells human resources and finance software is set to join the S&P 500 later this month. With us now for an exclusive conversation is Workday CEO Carl Eschenbach, who joins us from Amsterdam, and we'll get to why that is shortly. Carl, thanks for your time. Thanks for joining us. And, of course, a big week for you and the team, given some of these updates and, of course, expectations you'll be joining the S&P 500. Let's start with the AI proposition. New tools, new products for your customers. What does it do you think? What are you modelling in terms of the revenue uplift for Workday as a result of some of these new products?
Well, first of all, good morning, Tom. It's great to be here with you on your program. As you said, I'm joining you live here in Amsterdam at our annual user conference called Rising, where we have a record attendance of over 5,000 people joining us, of which 900 of those people are partners. So we have just a tremendous amount of energy right here in Amsterdam today. And yes, we are speaking a lot about AI, and we're talking specifically about Workday's next generation AI platform called Illuminate. And we are monetizing it. We have taken a multi-pronged approach to monetizing AI. First and foremost, our AI is built deep into our platform. It's not bolted on. So we are winning time and time again because of our AI capabilities that are in the platform. So our monetization shows up in our win rates, in our competitive advantage that we have. At the same time, we're rolling out new solutions, specifically agents. An example of an agent is a recruiter agent. A recruiter agent is something that allows recruiters to see a significant improvement in their productivity, up to 50%. It also allows them to accelerate hiring by up to almost 30%. But once you get those people on board, you got to maintain them. And we have another platform called Talent Optimization that reduces attrition by up to 40% as well. So we are monetizing all of our AI capabilities, and we expect that to continue throughout the year. In fact, just last quarter, Tom, we announced as part of our Q3 earnings call that 30% of our sales back into our customer base included one of our AI SKUs. We're super excited about the Workday Illuminate platform. Our customers are responding well, and the uptake has been even faster than we expected.
Okay, Carl, and look, you said it, monetization, and you're seeing the impact, because that, of course, is a key question around how AI is being embedded. Can you give us a broad estimate of what it means for revenues as you push into 2025? You're seeing that demand from customers. What does that translate to, kind of top line for you and the team?
Yeah, we're really excited about our AI platform. In Q3 was a quarter where we saw significant growth in AI, both in our recruiter platform, our recruiter agent. We have something called Talent Optimization, which is an AI solution. And then we also have a platform approach. And as part of that platform approach, we have something called Extend Pro. Extend Pro is an AI integration or API interface that allows customers and partners to bring, if you will, AI solutions on top of the Workday platform. And we are monetizing that. We have taken into account all of the momentum we see around AI, and we put it into our plans for both Q4, and we gave an early view of FY26, which begins in February, that includes our AI platform. We don't break out specifically what the impact will be, but we're counting on really good upside revenue from AI as we go into the new year.
Carl, are you embedding AI across the Workday business as well? What could it mean for efficiencies? What could it mean for headcount? Do you expect reduced headcount as you embed AI into your own business?
Yeah, we are absolutely embedding AI across Workday. We're using it across every single function in the company, whether it's in finance, whether it's in HR, whether it's in our product and technology organization where we're leveraging co-pilots, whether it's in sales and marketing. We are truly becoming an AI-first company in every way possible, both not only how we sell and deliver our platform to the market, but how we use the technology internally. And what we're seeing is we're driving significant efficiencies across our business. And we're not seeing it necessarily replace people. We're seeing people be able to move on and do different tasks and not have to do the tasks they once had to. And we're letting the AI take advantage and do that for them.
OK, look, you're pushing into Europe. You're expanding in Europe at a time when, of course, European growth is flatlining. Are you seeing any pushback from customers? How much caution are you seeing from your European clients at this point?
We're really excited about the European opportunity we have. As I said earlier, we have over 4,500 employees here in Europe, of which over 2,000 are based in Dublin. It's mostly product and technologies, and they're driving a lot of innovation. They're driving a lot of our AI solutions that we're bringing both to the European market and around the world. We're super excited about the outlook of Europe. We have over 2,200 customers in Europe today, and that's expanding rapidly, both at the high end of the market and what we describe as large enterprise and in the medium enterprise as well. And our partner ecosystem is expanding rapidly as well. Yes, there has been some headwind in markets like Germany and the UK, but we think it's only a matter of time before things switch and become a tailwind, just like we saw in years prior.
Carl, before we let you go, analysts are pointing to the fact, look, you've grown sales into existing customers, but there's been a bit of a challenge in terms of new subscriptions. Does that turn around in 2025? Is that a story that comes back for you in terms of new subs in 2025?
Listen, we're really proud of our growth. We're a company that's starting to approach $10 billion in annual sales and revenue, and we're growing in the mid-teens. Approximately 15% is what we've guided for the next couple of years. For a company of our size and scale, that is quite impressive. All at the same time, we're continuing to expand our operating margin. People talk about software companies being a rule of 40 company. We're well into the 40s at this point, and I think growing 15%, or approximately 15% over the next couple of years is something we should all be proud of here at Workday, and our workmates around the world are working really hard to maintain that growth.
Carl Eschenbach, CEO of Workday, thank you very much indeed for joining us on some of those new AI products, the efficiencies and the momentum that they are seeing with that business and the demand. Thank you. Now, some other stories making news this Wednesday. SpaceX and its investors have agreed to buy as much as $1.25 billion of insider shares at $185 a piece. And this is the important part, valuing the company at about $350 billion. That is according to an internal memo seen by Bloomberg. The staggering valuation cements SpaceX's status as the most valuable private startup in the world, with a market cap rivaling some of the largest public companies. London's IPO market has declined 9% this year, with only $1 billion raised, pushing the UK to 20th place in global IPO rankings. It's been leapfrogged by upstarts including, yes, Oman, a market that's about 1% the size of the UK, as well as Malaysia and Luxembourg. 45 companies have left the London bourse this year, 45 due to mergers and acquisitions, and many firms are opting to list in other markets like, of course, the US, but also the Middle East. Now, the Global Airline Association, IATA's Director General, says he expects the incoming Trump administration to support more consolidation in the industry. The group is forecasting higher airline profits next year as fuel costs start to come down. Willie Walsh spoke with Bloomberg's Guy Johnson.
Trump presidency, based on what we've learned from the first administration, is a net positive. You know, there will be challenges and there will be opportunities. I expect them to adopt a completely different approach to regulation. I think what we've seen under the Biden administration was heavy and unnecessary regulation.
OK, Willie Walsh speaking to Guy Johnson there. And as we look ahead to the coming holiday travel season, Guy Johnson will be speaking to the CFO of Flix, the company, the CFO of Flix, about how that company has become the leading long-distance bus carrier in Europe and the US. That premieres tonight in the US. In Europe, you can see it tomorrow at 6:30 p.m. London time. Coming up, Bloomberg Economics has been running the slide rule over Donald Trump's protectionist policies, saying they could have significant implications for the global economy. Of course, different scenarios coming through, different estimates. We're going to break down the details for you next. This is Bloomberg. Welcome back. Now, trade policies from President-elect Donald Trump are, of course, set to test economic resilience around the world, and it has been relative resilience. According to the latest outlook released by Bloomberg Economics, global growth will hit 3.1%. That is unchanged from 2024, while US growth is expected to drop to 1.9%. This, of course, is for next year. For more, let's bring in Jamie Rush of Bloomberg Economics. Jamie, we're just over a month away then, of course, from the new transition and the administration in the US. What are you and the team expecting?
Well, I think our base case is predicated on a relatively modest view of what happens in the US in terms of tariffs. So I think that if you think about some of the features of Trump's administration and what happened last time, it can point to perhaps tariffs not going up by as much as you might expect, given what he said on the campaign trail. And there's a few reasons. First, there are just moderate voices in his administration. Which will obviously make it easier which will make it hard for him to go big on tariffs. If you look at the Trump 1.0 playbook, what we saw was that he was very careful, or his administration was very careful about the design of tariffs. It was almost entirely focused on intermediate goods, so that's like inputs to production, which means that the inflationary consequences were kept low because that the increase in tariff costs could be spread across the whole economy. Rather than, for example, just taxing iPads or consumption goods. That has to get passed on straight through to consumers. So I think that's an important feature, and again, something that he's likely to follow. And then finally, you've got stock market discipline. If he puts a 60% tariff on Chinese goods and wipes out bilateral trade between the US and China, that's going to have very serious implications for the supply chains of some of America's biggest companies. the stock market tanking is not something I think he wants to see. So look, there's a huge amount of uncertainty out there, but we can think of a handful of reasons why he's not going to go big on tariffs. The threat is more useful to him as leverage than actually implementing them. And so we think that the consequences could be relatively modest globally. And the peak channel for the main channel for Europe, for example, and for other economies around the world will be uncertainty, higher uncertainty, dragging on the economy, putting people's investment decisions on hold and causing trouble that way.
Well, how much of your assumption around tariffs is tying into your view around inflation? Because you forecast in this report that inflation will remain pretty uncomfortably above target, at least for the Fed and the BOE in 2025.
Yeah, so we regard that more as a legacy issue from the Biden administration, really. I mean, the economy has held up much better than people expected it would in the US and, in fact, globally, given how high interest rates have gone and how fast they got there. Strong labour market. I mean, it's held up surprisingly well. And until we see sort of further weakening, it's going to be hard to imagine that there's a sudden weakening of inflationary pressure in the US. So we do expect core PCE inflation about 2.5% across the year. Something similar for the UK. We still have a very tight labour market here. The one that stands out as being different, though, of course, is the Eurozone, where I think we can say pretty confidently that inflation has been defeated. And in fact, we're forecasting the price gains to be less than 2% on average next year.
Jamie Rush from our Bloomberg Economics team breaking down some of the key findings, at least forecasts into 2025. Really worth a read. You can check it out, of course, on the terminal. Parts of it, of course, will be reflected on Bloomberg.com as well in terms of your understanding of how this global economy could adjust in 2025. Jamie, thank you. Staying in Europe then, Bloomberg Economics is forecasting as part of that report and analysis another 100 basis points of ECB cuts in 2025, another full percentage point. I'm joined now by Melanie Debono, Senior Europe Economist at Pantheon Macroeconomics. Melanie, thank you for joining us in the studio. Before we get to your views on 2025, we have the ECB meeting tomorrow. There have been some debate. Some have suggested maybe they go with a jumbo 50 basis point cut, given where inflation sits in the Eurozone, given the challenges around the economy, what we're seeing in Germany and France, particularly the core. Would you align with that view? Do they go jumbo tomorrow?
They will not go jumbo tomorrow. So our forecast is for a 25 basis point cut. And the reasons for this are twofold. Firstly, inflation has come in lower than the bank actually expected. It thought that inflation would rise, but it's risen less than it expected. And also, we've had a lot of comments from governing council members in recent weeks arguing for a continued gradual approach to easing. So 25 would be the way, especially now as we near the neutral rate. If the bank goes for a 50 jump, then...
Do you have a steer on what the neutral rate will be?
Well, I mean, it's highly uncertain exactly where the neutral rate is. Some members from the governing council have argued that it's close to 3. Some members have argued it's close to 2. We're going straight down the middle, and we expect that the neutral rate is somewhere around 2.5%.
Okay.
And so given that we think that the neutral rate is around 2.5%, and that we think inflation at the end of or closer to the second half of next year will come up again, we actually have less cuts factored in for 2025 than most of the consensus and markets.
Yes, markets expect sub 2% by June. Yeah. Where do you see rates ending 2025 in the ECB?
So we have the terminal rate at 2.25%. So we've got a cut in January, a cut in March, and a cut in June, such that the ECB will stop its current easing cycle.
What holds them back?
Well, we have inflation coming up above target again at the latter half of 2025. We understand that the risks to our forecast are probably to them doing more than we expect. And the reason for that could be because they think that the neutral rate is towards the lower end, somewhere between 1.75 and 2%. And maybe they see that the fall in the first half, fall in inflation in the first half of the year could push them to go into an accommodative policy. But we don't expect that to be the case at the moment.
What underpins your view around potentially higher inflation in the second half? Is that a Trump tariff story?
It is not at the moment, because what the Trump administration will do after Trump's inauguration in January is highly uncertain. So we think that at a minimum, they'll go ahead with 20-25% tariffs on most of the globe, including Europe, and that will lead inflation in the US higher and also will be somewhat inflationary for the Eurozone, but we can't really put a number on it before we know what's actually going to happen. So the reason for our inflation forecast rising in the second half of 2025 at the moment is largely base effects on energy.
Okay, so that's a base effects energy story.
Yes.
How have you adjusted your view on the outlook for the French economy, given the politics of that country?
Well, at the moment, again, we don't know what the budget will be like. So we don't know what, if any, new government is put together.
Even if there will be a budget.
If there will be a budget, exactly. So there's a number of countries which have rolled over budgets plenty of times in Europe. We've seen this before in Belgium and Spain. So it wouldn't be the end of the world if France has to do it as well one time. But of course, we're seeing comments from the governing, from policymakers that they don't want that to be the case.
Okay, Melanie, excellent insights as we look ahead to the ECB decision tomorrow. Thank you very much indeed for coming in bright and early into the studio. Melanie Debono, Senior Europe Economist at Pantheon Macroeconomics. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Wednesday. Happy inflation day. Here are the estimates then ahead of that key CPI print out of the US later today, 1:30 p.m. UK time. Focus on core. Month on month, expected to come in at 0.3% for the month of November, in line with the previous month. And you've had a string of numbers around this 0.3% level, which suggests that the core, there is an element of stickiness there. Top line, headline number expected to come in at 2.7%, just edging up from 2.6%. That is, of course, year on year in terms of the headline number. But arguably, you want to be focusing on core on a yearly basis. 3.3% is the expectation. Markets currently expecting at about an 85% chance that the Fed goes again on December the 18th. It's the question mark into 2025, of course, that remains in focus. That is inflation data out today. That is the forecast and the preview. Let's flip the board and have a look about what is happening in the IPO market here in London this year. This is Bloomberg reporting. We've crunched the numbers, and it's been another challenging year. Fundraising on the London IPO market dropping 9%. You've had about 45 companies in the UK either being snapped up as part of M&A or listing in the Middle East or the US instead. And the woes, again, of the London IPO market, we are now ranked, get this, below Oman, Malaysia and Luxembourg. Is there anything the authorities can do and the London Stock Exchange can do to arrest this decline? Later today, US Treasury Secretary Janet Yellen will be sitting down for an exclusive interview with us. That's at 3:30 p.m. UK time. The opening trade is up next. This is Bloomberg.